What's up everyone, it's Kadi with MoneyVest. So in this video, I wanted to break down 4 reasons behind the strong rally from last week, okay? And these are 4 things that basically changed in the last 1 week, and some of them are my speculation, some of them actually did happen. So I'm going to break down and kind of give you some more clarity as to what really took place in the last 5 days, last pretty much week here. And we've seen the markets, be on this very, very strong momentum as the NASDAQ and the S&P 500 were up over 5 to 6%. That's right, 5 to 6% move in the S&P NASDAQ in 1 week is actually a pretty substantial move. So this right here was the rally S&P 500 with a very nice green candle up over 5.85%, and the NASDAQ, you'll notice, was up over 6.6% with a very significant rally. Not to mention NDX 6.5%, which is a NASDAQ 100 more specifically as well. So we're going to break all of this down. Hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like. I would really appreciate it if you subscribe to the channel as well. And link to our Discord and Patreon is going to be down below. If you're interested in joining, I did share a new spreadsheet with all the members yesterday. The intrinsic value spreadsheet comes out this weekend. And I also did do a private members only video going over my trading system and the data and the spreadsheets that are going to be very, very useful and super valuable for every single person who is going to be looking at swing trading opportunities, right? So definitely do check that out. I opened up a couple more spots. That's the only, October time. October, November, like each month we open up a few more spots. So link's going to be down below if you are interested in joining. And we'd love to have you on board. If you have any questions, feel free to reach out. So the first reason that we are going to go over is I speculate and I believe the money market funds, they are now starting to, some cash that's been sitting on the sidelines, of course, rotating back into the market, right? So money market funds, as we know, have been paying you very nice 4 to 5% yields for such a long time. But because of the sell-off in the market in July, August, September, and October, so last 4 months have been, the markets have been down over 10 to 12% from their recent highs in July. So we've gone into a correction territory. I do think, and I believe, and I speculate that there's a lot of money that was sitting on the sidelines, kind of waiting for better prices, better yields, have now started to, move back into the market, right? So we've seen that liquidity come out of money market funds, which again, this will be updated because as of the second quarter, we were sitting at a record high of almost $6 trillion. That's right, $6 trillion that was sitting on the sidelines just in money market funds, right? And this right here was the article from September 1st, 2023 from Bloomberg. The money market funds assets climbed to a fresh record of $5.58 trillion, which was again increased to $5.9 trillion as of, again, the second quarter. And I'm estimating that number, has been fluctuating quite a bit. But I do believe that with the last week's liquidity, with last week's momentum, it is possible that, yes, we did see a lot of, sort of funds flowing back into equities, because if you take a look at the last 1 week's heat map, everything is green, right? All sectors were green in the last 1 week, which we'll get to that in just a minute, but a lot of funds basically flowing back into equities. The second reason was the yields, right? The Treasuries. In other words, the rates for the Federal Reserve and the Treasuries. So those are both 2 reasons. The number one is obviously going to be rate cuts. So what you'll notice is that the market earlier was pricing in some probability for a potential for rate hike, and only 3 rate cuts for 2024. So expectations changed after the Fed meeting. So Fed meeting was on Wednesday, and expectations did change. We were talking about a technical rebound last week as well, right? So I mentioned this in our previous last weekend's video. I mentioned that technical rebound is possible considering how oversold we are, considering that volatility is trading back up to 22-23%. Of stocks trading below their moving averages is still pretty, low compared to where we have been in the past. So a technical rebound is a possibility, and it came in violent with a very, very aggressive move to the upside on the back of these expectations changing. So this basically changed in the last 1 week. I mean, we were expecting 3 rate cuts. Now the market's pricing in 4. Not to mention the Treasuries also did have a pretty significant sell-off on the week, right? So 10-year Treasuries, they were down over 5.48%, so almost 5.5% sell-off in the Treasuries on the 10-year yield, and we are now sitting at just under 4.6%. That's reason number 3. That's probably the biggest reason why we saw a lot of liquidity flood back into equities and even the bond market. So both equities and bonds, stocks and bonds, they both did really well. It wasn't just stocks that did well. Bonds also rallied quite a bit. TLT, TMF, a lot of these other bond ETFs did really well because yields were dropping. And that, again, is going to create that, sort of excitement among investors that if they want to lock in these yields at these levels, 4.5%, 4.6% for 10 years, trust me, a lot of endowment funds, a lot of institutional investors, pension funds, sovereign funds, a lot of these, funds that are being controlled by countries, by institutions, they're not looking to beat the market, right? They're not in the business of beating the market, right? Beating the market is only for hedge funds, for straight up institutional traders, right? When you're looking at endowment funds, when you're looking at sort of college endowment funds or sovereign funds or just funds from managed by or for the country, they're looking to keep up with inflation and somewhat generate somewhat of a higher rate of return than inflation. And right now the treasuries are higher than inflation. So the fact that demand has still not creeped in only tells me that there's expectations that they're expecting the yields are going to be higher. But the moment that changes, right, the moment that starts to flip, that okay, yields are not going to go any higher, like this is it, 5% is it, you will see a lot of demand flood back in to try to lock in that 10-year rate for treasuries, right? 4.5%, 4.6%, for these pension funds, for these endowment funds that are managing hundreds of billions of dollars. It's a pretty substantial number, right? 4.5, 4.6% for 10 years. So this right here was one of the first weeks that we saw a pretty sizable sell-off in treasuries, which once again is driving liquidity higher in the bond market and of course for equities, because valuations and present value of all future cash flows depends on where the risk-free rate is. Perhaps one of the most important reasons why the markets rallied the way they did. And lastly, I want to talk about the market participation. So it wasn't just M7 or big techs that actually rallied and resulted in a very strong move in the S&P or NASDAQ. It was broad based, right? So look at the RSP. That's your equal weighted index. This thing was actually higher on the week compared to the S&P 500. That's right. So S&P 500 was up 5.85%, and the RSP, which is the equal weighted index, was up 5.93%. That should tell us a lot about what happened in the last 1 week. So if I come over to Apple, Apple was up 5%. Amazon in the last 1 week was up 8.5%, right? Tesla in the last 1 week up over 6%. Nvidia was probably up a lot, so it was up 11%. AMD was up over 16%. Microsoft was up over almost 7%, getting back up to almost all-time highs. Google here, on the other hand, up 5.6%. Meta was up over 6%. So if I come over to the entire index, the M7 index that we have created, it was up a little bit over 7.5%. But the fact that the equal weighted index was up more than the S&P tells us that there was a broad-based rally with a lot of other sectors participating in this momentum back higher. So that is actually good news, because we want to see more and more stocks participate and not see this market rally concentrate into just a few names. Because when that happens, the market breadth is weak, and those types of moves usually do end up getting fading out, and we do see rallies kind of fade and start to roll right back down. But because it was such broad based, and because of the fact that yields are rolling over, rate cuts expectations are higher, and not to mention, in my speculation, I do believe the money is starting to flow back into equities and bonds. There is a possibility that these rallies do hold up, and eventually we do see a bigger breakout. Now, it's very much hinging on the idea that there is not going to be a recession and there is going to be a soft landing. That's really what the market's pricing in at this point, because rate cuts is what the market is expecting. 4 rate cuts is priced in right now in the market. And if you do have to go through that repricing, that okay, inflation doesn't come down fast enough, or there is some level of soft landing and the economy continues to be strong, labor market continues to be strong, well, to that, the Federal Reserve is going to see that, and they're going to want to raise rates even further to control inflation. So that's really where all expectations are hinging on. It is the idea the economy is weakening, right? Because we got the labor market numbers, unemployment numbers, it ticked higher, 3.9%, and inflation at the same time is coming down. So these expectations you see for the next year for 4 cuts is hinging on the idea that the economy is weakening and inflation is coming down. If those things don't happen, the market does open itself up for a huge repricing risk, which we'll get to when we get to that. We'll cross that bridge when we get to it, but that's really where we are. Now, on the back of these expectations, is it possible for the markets to rally more? Absolutely. I mean, we've got very, very important levels. Like I said in my market update video, the market's coming up to a huge resistance that it's going to be testing next week. So 4,400 is a big threshold for the S&P, and the NASDAQ is going to be coming up to 13,700. So those are going to be key levels to watch going into next week. But yeah, that's where we are. So hope you guys enjoyed this video and found it helpful. The 4 big reasons for the markets pushing higher the way they did last week. Broad participation, lots of liquidity flooding out of money market funds, in my opinion, over to bond and stocks. And of course, the rate cut expectations have increased to 4 now for next year, and Treasury yields dropping pretty aggressively, almost 5.5%. And that's obviously creating this optimism, this risk-on environment in the markets once again. So hope you guys enjoyed this video, found it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the members-only videos, intrinsic value spreadsheets, a lot of other cheat sheets that we have created on Excel that I think are going to be super valuable, super helpful. I did open up a couple more spots, so links going to be down below. As always, happy investing. I'll see you all in the next video.